Welcome to Turning Hard Times to Good Times. I am your host, Jay Taylor, and I'm speaking to you from New York City on this, the third day of April 2018. Do like to remind you that I'm the editor of Jay Taylor's Gold, Energy, and Tech Stocks, and you can subscribe to that by going to miningstocks.com, miningstocks.com, or call our office in New York, 718-457-1426, 718-457-1426. We do like to also remind you that we're affiliated with Chen Lin. What is Chen buying? What is Chen selling? You can subscribe to that letter by going to chenpicks.com, chenpicks.com. I want to thank each of you for listening to the show, making it one of the more popular shows in the Voice America Business Channel. I also want to invite you to continue sending along your questions, criticisms, praises, whatever you have to say about this show. Send it to questionsfortaylor@gmail.com, questions, the number 4, taylor@gmail.com. And, of course, we do want to thank our sponsors for making this show economically viable. Our sponsors for today's show, RN Resources, Bonterra Resources, Dynacor Gold Mines, Genesis Metals Corp., Klondike Gold, New Range Gold Corp., Northern Empire, and Novo Resources. I've titled today's show, China's Plan to End Dependency on American Trade. Alistair McLeod, Michael Oliver, and Brian Groves are return guests today. Superpowers prevail and expand until the hand of God says no more. Financed by what can only be defined as a fraudulent monetary system after Nixon removed the intrinsic value from gold, from the dollar, by taking gold away from it, the U.S. was able to create seemingly endless amounts of money out of thin air to fund military and clandestine activities, to expand its presence around the globe, but also, of course, for politicians to give goodies away to those who vote for them. As the Soviet Union was in the process of its own statist self-destructive design, in order to ensure it went away peacefully, President Bush promised the Soviet Union that NATO would not encroach on Russia by taking former satellites of the Soviet Union into NATO. But alas, that promise has been broken, with numerous former Soviet satellites taken into NATO now, becoming members of NATO. And now NATO entirely encircles Russia, even as neocons would have you believe that Russia is even more of a danger to us now than it was during the Cold War. For reasons that are entirely understandable, Russia doesn't like the U.S. threatening its sovereignty, nor does China appreciate the U.S. telling it that it doesn't have the right to control its own sea lanes in the South China Sea. Given these geopolitical realities, which so far, as we know, continue to include the U.S. military being second to none, it isn't surprising that both China and Russia and other countries aligned with them are fighting back by targeting the U.S. where it is most vulnerable, namely with its deteriorating economy and financial system that is built not on the rock of a sound gold-backed currency, but rather an increasingly vulnerable fiat-based monetary system that is based on debt. And if that debt can't be paid, the system becomes increasingly insolvent and unstable. It was the financial crisis of 2008-2009 that hurt various countries around the world, that caused China to start to implement ways to lessen its dependency on a dollar that is increasingly unstable, and to create a monetary system of a more sound footing, perhaps based on gold. At least we know for sure that China has been encouraging its citizens to import gold. By all credible accounts, massive amounts of gold have been flowing into China from the Western world. At the same time, Russia has built up its gold reserves, as have other countries friendly to Russia and China. In addition, China and its partners, the BRIC countries, Brazil, Russia, India, and South Africa, have begun building a massive new trading and institutional infrastructure, including a system of global monetary transfer, a banking system, as well as railways, highways, and sea lanes for trade that are outside of the Anglo-American Empire. Well, in the second hour of today, the second half of today's show, I should say, Alistair McLeod will join me from his home in England to discuss how China is using its rising economic power to gain independence from the abuses of the U.S. dollar hegemony, and what that may mean not only for our financial markets, but for our economy and the privileged way of life that most of us post-World War II babies have become accustomed to. While Alistair will provide us with a possible view of the impact of declining dollar in the Western world, Michael Oliver will be with me in just a moment to step aside from the theoretical to relate what is actually transpiring now with some major tectonic market changes, including what looks to be a new paradigm in the markets that may be taking us back to the stagflation days of the 1970s, or possibly, God forbid, something worse. Now, if gold is the antidote for China in a world in which the financial system is in the process of self-destruction, I firmly believe gold will likely also be the antidote for folks living in the Western world who are able to pull their heads out of the sands of massive propaganda aimed at keeping all of us conned into believing in government and central bank miracles. Most people will be sucked into the mainstream propaganda and will suffer greatly as a result, but I'm guessing that many, if not most, of the listeners of this show will realize the dangers of continuing to buy without question everything you hear in the mainstream media. How many brokers do you know that are suggesting that you have at least a small amount of your portfolio on gold and silver and the companies that produce those monetary metals? Well, it's amazing, but most people don't realize just how well gold has done relative to stocks since the beginning of this new century. I'll bet you didn't know that since January 1, 2000, gold has risen by 462%, while the S&P Total Return Index has risen by 263%. In other words, if you had purchased the S&P 500 back then, you would have, if you'd purchased gold, you would have been 200% better off with that investment than if you purchased the S&P, and that includes dividends that went into the S&P owners. But Wall Street has its own products to sell, and it can't make money selling you gold. So gold's performance is a dirty little secret. It's kept from you. One person who would not be amazed by gold's outperformance relative to stocks would be Michael Oliver, and I'm pleased to say hello to Michael. Thanks for joining me again today, Michael.
Hi, Jay. Good to be back.
Always good to have you back with me because of your accuracy. The work you do has been so dependable, so helpful to me. You put out something this morning just showing a shorter-term comparison of gold to the S&P. This is a year 2000. Well, this is since 2015. We've seen the equity markets rise dramatically, but gold has done almost as well, right?
Yep, it's S&P at its peak. If we start from the close of 2015, now remember, in late 2015, the S&P was under pressure like gold. It was well off its highs, and basically, late 2015, early 2016, a lot of commodities and stocks turned up simultaneously. Oil made a low about the same time as the S&P did, early 16. Gold made its low in the tail end. The lowest monthly close is the December close of 2015. So they were, somewhat in sync. But the S&P went up 38% to its January close of this year, measured from the 2015 close, whereas gold has been hovering for the last few months up about 25 or so percent from its 2015 low. Now, with the S&P wobble that we've just had, or I call it a breakage, the difference is about 0.5% from the 2015 close to the present. Now, remember, this is a period when gold has not performed well versus the S&P, instead of that long-term picture that you discussed going back 20 years. So gold, I showed a simple column chart of gold and S&P right now. It's measured since 2015, and you can barely tell the difference. Yet nobody in the financial press is talking about gold.
No.
And the sudden change now where they're neck and neck instead of one column being shorter than the other. Gold is neck and neck with the S&P. It's in part due to two things. One, the S&P dropping, and two, gold hanging in tough near its upper end of the multi-year range here. I did a momentum study of that performance since 2014, and it broke out last month. So monthly momentum says it's not only this firming of gold relative to the S&P or weakening of S&P versus gold. It's not just some near-term phenomenon. It's actually a breakout. Therefore, it looks to me like gold is now likely to continue to outperform and outpace the S&P. Now, maybe at some point the financial press will actually get hold of that story and mention it. But for the last year or two, nobody's mentioned the fact that gold's done quite well despite the smokescreen in the stocks. And, of course, as investors get disenchanted with stocks, they got to go somewhere. And gold's been behaving well. So it's not like it's a feel-bad market. It's a feel-good market, and I think it will attract a lot of the money. It certainly feels better than Bitcoin.
Well, I mean, speaking... go ahead, Michael.
No, go ahead. Go ahead.
Oh, I was just going to say, speaking of stocks, I mean, they're looking wobbly right now. What are your momentum indices saying about?
Broken. I think it's over now.
You're broken, yeah.
Yeah, I think the top's in place. We were waiting on the NASDAQ 100 and the PNQI, which is the ETF of internet stocks, the leaders, in other words, Google's, Amazon's, etc. They both broke. And the break in February in the S&P and most developed market indices around the world was conclusive to us, but NASDAQ and the PNQI did not break key structures in the February break. They did this week. And now I think the game's on. Also, if you plot NASDAQ 100 performance relative to the S&P, it's in sharp decline. And it's not just in decline, it's in breakage. In other words, it's breaking momentum trend structures of the relationship, indicating there's more to come. So going forward, we expect the market to go down and NASDAQ 100 to be a leader on the downside, just like it was on the upside. The only question in my mind is, in what manner is the decline unfold? Could we crash? It's possible. Or are we going down in sharp layers? I'm more inclined to think sharp layers. I see some support in NASDAQ 100 about 10% below here. Now, that's a pretty bad percent, considering you're already well off the high. So, if you get the NASDAQ 100 down, 5,900 area, about 10% below current market, I'm watchful for a possible shelf of support, not a bottom, just a shelf of support that might cause a rally. But if we go trashing through that level dramatically, then, we could be in crash mode. And I frankly don't know the answer to the nature of the decline. I am just a bear now, fully bearish.
Well, it seems pretty clear that the equity markets are not going to go down without a fight. I'm looking today at the Dow is up 350 points as we speak. NASDAQ is up 1.18%, up 81 and change. S&P's up strong. So, there's a lot of believers. We've had a long bull market, and it's pretty hard to convince people that you don't want to be in stocks. You got to be there.
Yeah,
got to be in it to win it.
I quite agree, and we've warned our subscribers that that you can get these rallies that just curl your hair. And so, if you are short these markets, you better be short in a way that you could accommodate your portfolio, your wherewithal. Heavily leveraged, if you can't afford it, don't do it. And also, you don't have to do it all at once. You can do it piecemeal. It's a dangerous situation, but I do think the top has been made. And the only question now is, in what manner do the legs of decline unfold?
Yeah, and what I really appreciate about about your work, Michael, is the momentum charts that you show so clearly. For example, I'm looking at the one you talked about earlier on gold, and quite clearly momentum is broken out, but you couldn't tell that by looking at the gold chart, at the price chart. So, this is typical of what you do, and same thing on the downside, of course, with stocks and so forth. The momentum, the structure is broken, and then, it just works. It seems to work amazingly well, which is why I'm so thankful that you come on to talk to us every week. It's really great, and I should tell everybody, it's Oliver MSA, olivermsa.com. Go there, learn more about Michael's work, and if you are a serious investor, you may want to think seriously about subscribing to Michael's letter. Thank you so much for being with us again, Michael, and
thank you,
hopefully
Jay.
You can be with us again next week.